time. Now, let's go to the same time period, not time period, the same sort of range, way back on this analysis. I think this analysis will do it for us. If we go back to, here we go, and I just need to position this chart, and I'm going to show you a picture. This is way back in 1962. There we go. Okay, so this chart is 1962. If you can see the time scale, if you've got better eyes than me, this is 1962 until 1972. Okay, now let me point out a few things about this analysis. From 1962 until 1972, this 10-year period, this analysis of the market, and it's a very viable, I'm not saying it's definitely the textbook correct analysis, but it's a viable, possible analysis. This positions a very long 18-year cycle trough here at the beginning of the chart. It then has a 54-month cycle trough over here, which is what we call a straddled trough. Notice it seems it looks like the neck of a mountain pass. It's a very insignificant trough relative to the troughs either side of it. And then there's an 18-month cycle trough that follows it. Okay. Then the market bounced up fairly strongly. At which point, if you were following this particular analysis, you would have said, that analysis can't be right. Now let me just turn that off and let me switch back to this chart, which is if you remember the chart of current time period from 2003 until 2011, and I'd like to point out exactly the same two features to this analysis: an 18-year cycle trough right at the beginning here, a straddled 54-month cycle trough over there, and then a much lower 18-month cycle trough over there. Okay, the comparison between these two analyses is staggering. They look almost like exact copies of each other, both in terms of the move in the market and the analysis that has been performed upon them. Let me just go back again to the other one. Now, let's slide forward and see what happened after this situation played out in 1972. Okay, what happened was not good. All right, as you can see, the market fell really sharply to an even lower trough in 1974. Okay, that's what happened back there in 1974. So, of course, that's why I am watching this particular analysis with great care, because I am interested to know whether exactly the same thing is going to happen to us. There is one very clear and strong difference, however, and that is that if we go back to the 1974 period, then you will notice that the time period between this 18-month cycle trough and a strong trough in the market was exactly 18 months. Now, most analysts would have positioned the 18-month cycle trough over there. Sentient Trader hasn't. Why? Because with the benefit of hindsight, it believes that this was in fact also a straddled 18-month trough, and it played out for 26 months. Okay, and if we now compare that to the current period of time, that would be exactly the same thing as saying that this 18-month trough, although it seems apparent, isn't an 18-month trough, and then in fact we should position the 18-month trough somewhere over here. The obvious place to position that 18-month trough is over here. Okay, unfortunately, as you'll see when I measure it, that trough, that total length of time is just under 30 months. Now, 30 months is too long for it to be considered to be an 18-month trough. Always when there are things that seem to be playing out again, or echoes in the market, or history repeating itself, that comparison will always inevitably break down. And I suspect that in fact this comparison has broken down, and that a direct comparison is no longer absolutely applicable. But it's a really interesting thing to look at, and and something to leave you with to think about over the next week. With that, I'm going to bring today's Trader Chat to a close. Thank you very much for your time. I'll answer a few questions if you have any. A couple of questions regarding the S&P. Given the S&P has been moving without any significant drop into a cycle, and the FLDs are forming a cascading pattern, how's the best way that Sentient proposes trading this market where there is no clear cross of an FLD? Okay. Well, that's a really interesting question, John. And in fact, I can show you to some extent, what's sort of happening simply using the Dow, because the Dow has been doing a similar thing. What John is pointing out is that it's very hard to find these cycle troughs in the current market. As you can see, the current market is going up in an ever narrowing band. It's I guess you call it a rising wedge or something. There's an ever narrowing band. Oops, I'm not very good at drawing with my mouse. Okay, so price is getting squeezed into an ever narrowing band. So one of the first problems you must understand about that is, that's right, there aren't any troughs. There aren't any clear troughs in the market. The first thing you must understand is that it makes the analysis very complicated. Not just for Sentient Trader, it makes it complicated for everybody because you simply can't find the troughs. Okay, the cycles are forming troughs, but the price isn't really moving with it, and it's something that tends to happen in my experience, and I could be wrong about this, but it's something that tends to happen prior to really dramatic things happening in the market, which is why I think it's a very dangerous time. It's a very, very dangerous time, and so as William says, you have to wait for the FLD break, because the FLD break will occur. Of course, FLDs don't have to be broken. It's not like Elliott wave theory, where there are certain absolute steadfast rules. According to Hurst's cyclic theory, troughs can form above the FLDs. FLDs aren't always crossed. Okay. I see another question from Chris. I'll get there in a moment, Chris. I believe it's a very dangerous time. It's also time to be wary, because this analysis is based on really subtle troughs, okay, that are occurring here in the market. So someone's got to be very, very careful, because the analysis might well be flawed. I think that's a repeat, is it? Yes. So one has to be very careful, and one has to question the analysis all the time. You have to probably run 2 or 3 analyses side by side with various alternate positions for this 20-week cycle trough, for instance, which the default analysis places on the 30th of January, because that was the most prominent trough. 30th of January this year is the most prominent trough we've had in a while, and it occurred at 16.9 weeks. So the indication is that probably is the trough of the 20-week cycle, but you need to treat it with some suspicion and consider that in fact the 20-week cycle, we might still be waiting for that trough to occur. Okay, there have been only 147 days since the really prominent trough on the 4th of October 2011. It's not impossible that the 20-week cycle is still stretching out. We might not have seen the 20-week cycle trough yet, so one needs to be very careful and watch for FLDs when they get crossed by price. I see, I think I've missed 1 or 2 questions there. Let me just go back. There's a question from Chris. Why does Yahoo data not show the open high-low close as a candle in Sentient Trader when it's imported into the spreadsheet from Yahoo? Okay. The reason for that, Chris, would be the format that you are using to read your ASCII data. And in fact, I'm using the incorrect format here. If you go to Tools, Redefine Default ASCII Format, you will see that the format that I'm actually using here was an old format that I didn't change, and it's importing date, then it's ignoring the open, and it's reading the low as a close price. Okay, so you need to change these to open high, low, close, and so on and so forth. Okay, so it's the format that you're using to read your ASCII files. Okay, and that's I used incorrect format. So in fact, I'm working off low prices, I believe, instead of close prices. But on a very long-term analysis, it doesn't make any difference, or doesn't make much difference. Okay. Next question from John. When trading individual stocks within the S&P, and if Sentient recognizes the drop is due or imminent for the index as a whole, is it best not to take long trades, or should we be confident in the analysis? Well, certainly if you're trading stocks which are within the S&P, a very sensible way of trading is to perform an analysis of the overall market, and then to perform an analysis of the particular sector that you're trading, and then to perform an analysis of various stocks that fall within that sector. You use the analysis from the bigger picture to inform the analysis in the smaller term picture. Some stocks move contrary to some extent to their sector that they're trading in, or to the S&P 500 generally. For instance, Apple has very different troughs to the S&P 500. But as a general rule, one should only really trade a stock which seems to be in sync with the cycles of the sector that it's trading in and the market in general. Because what will often happen is, if a particular stock has different cycles at play, or different cycles affecting the price movement, then either your analysis is not great, or at some point that stock is eventually going to fall back in line with the general market as a whole. So I would recommend that you focus on stocks that are showing a similar cyclic picture, unless over a long period of time they show very different cycles working, which is certainly the case with Apple. But in fact, one day we should do a trade chat where we compare Apple and the rest of the US markets and so on. But that would be my general advice. I know there are people who take the opposite approach and say that you need to find stocks that are outperforming or are performing contrary to their sector, and you trade them in such a way that you expect them to return before long to their sector. Okay, that's my answer to that. I hope that helps. All right, Mark, Hurst said that for any given situation you should first assume that no prior knowledge is available on the equity in question. How does that fit with looking back at similar previous chart movements? Well, I think that looking back at previous chart movements, I don't think one expects the market to repeat history exactly. But I think looking back at similar previous chart movements, I think what's important is you look back at times when the arrangement of the cycles was similar to the arrangement of the cycles as they're playing out at the moment. Cycles are, of course, cyclical, and if we are presently somewhere within range of a 9-year cycle trough, which is the first 9-year cycle trough after a 36-year cycle trough, for instance, then I think there is validity in going back and having a look at the last time that happened. I don't think that's assuming prior knowledge about the equity, but I think it's having a look at how cycles have affected the equity or the market that we're looking at under similar cyclic conditions. Of course, the cyclic conditions are never exactly the same, because there is a 54-year cycle out there, which is different. There's potentially a 108-year cycle, which is very different to what it was in 1974. And there's a 216-year cycle, which is again different to what it was like in 1974, and so on and so forth. So what I think tends to happen is that cyclic pictures unfold in similar ways surrounding cyclic events. So when a 9-year cycle trough occurs, and it's the first cycle trough after a previous 54-year cycle trough, I think there will be similarities in the market action that plays out around those time periods. I don't think that's taking a look at. I don't think that's using prior knowledge. about the equity. I think it's a sensible approach, but of course everything, these things all have their limitations. You get things playing out in the market